Rob's Child. Nothing I say is investment advice, and I have no intention to replace any content of security analysis, but to open the contents up for discussion. We're on Chapter 40, Capitalization Structure. At this point in the book, I feel like I'm completing a puzzle in which every piece I pick up, I already know where it goes, it fits in, and then it makes the full picture look that much more complete. If you've made it this far in the book, you might be feeling the same way. I just wanted to mention that as we get into this. This chapter really clarified a heck of a lot of things for understanding about everything. Like I'm saying, like they're like puzzle pieces that just make the whole picture look so much more complete. So, on to the specific details of this chapter. So, the main takeaway from the whole chapter is that when a company has bonded debt, it essentially adds leverage to the common stock. And I'll just go through the points of the chapter to help understand this concept. But essentially, that's the message. And so if you're looking at a company, you're looking at their balance sheet, and they're holding a ton of debt compared to the amount of capitalized stock that exists. You know, it means that the stock is more leveraged. The more debt there is compared to the value of the stock, the more leveraged the stock is, in a nutshell. I wanted to bring up, along with that main point, that right now with rates going from 0 on the front end of the curve and up to today where it's 5.5% on the short end, and also the long end going from 0.7% up to it did cross 5% recently. This is in 2023. You got to consider how stocks are going to be leveraged against the higher interest that companies have to pay on their bonded debt. And, smartly capitalized companies are going to be using as much bonded debt as possible in order for the stock to become more attractive. And I mean, that's just a general thing companies need to be doing. And in a super low rate environment where, it's expected for the rates to stay low, earnings have to be so much higher now in order for companies to be able to survive as their debt rolls over. It's just incredible to me. And it just makes me right now a lot more scared of a lot of stocks right now in the markets. But let's go through the points of the chapter. Hopefully, all these points will, if you're watching this and you read the chapter, just to reiterate and go over in our minds like how this works and why it works this way. So, first point is that he says, optimally, seniors, in other words, bonded debt and preferred shares mostly, are issued to the extent that they are considered to be a safe investment. And so I just basically talked about that and how, if you can get much cheaper debt, the interest payments are so low, you can have an incredible amount of debt and it can leverage your stock so much. Like, why wouldn't you do that? And then, with rates going this high, it's scary for companies out there right now because I'll try to stick to the subject of the chapter though. So then we have a point is that he mentions that no bonds is a over conservative setup for capitalization structure. I'm going to point out, what he considered to be investable in the very last chapter. Two of those examples from the type C had no bonds, and so I find that to be kind of interesting that those were the examples, and then we're just laying it out right here that that's overly conservative. But anyway, I love how he points out that it's similar to if it's a private business, that it's overly conservative for someone to use all of their own capital to fund a business where they could be taking out debt, the appropriate amount of debt where they can easily pay the interest, and then they get to keep the profits on top of that. So I found that to be a really good, healthy explanation from the beginning of this chapter. He makes a point in this chapter more closely tied to, I think, what was going on in the 1940s, in that he's making a strong claim that strong industrials don't sell enough bonds, and it's bad for everybody, because what happens is that people that need to buy bonds for whatever reason, they need that steady income, and they don't want to have any speculation. It's when there's not enough of these bonds, it makes a bad situation for everyone. So what ends up happening, though, is people seek higher risk bonds, which are just not good. And then it's not good for the stockholders because they're not getting, the higher risk reward that they should be getting. And like he's saying, it's pushing people that want to be investing in more conservative investments, or at least have a bond part of their portfolio. Is pushing them into more higher yield corporate bonds and preferred shares. And then like I said, what ends up happening in this scenario is the working capital ends up being too dependent on the common shares, even though it makes the quality of the stocks sort of better, because when you have less payments you have to pay the bonds, and there's more left over for the stocks, but it's not as leveraged. But then the additional downside to this is that extra security ends up putting a premium on the stocks, and so you end up with stocks that are just simply too expensive, and who wants to buy expensive stocks? Anyway, I wanted to bring up at this point to have a reminder that industrial earnings should cover interest more than 2 times. He says 2 times isn't enough. I forgot what he said earlier in the book. I looked it up. I believe he says something like 5 times interest. Again, correct me in the comments if that's not correct. So then, this entire first part of this chapter is based on a hypothetical 3 companies, A, B, and C, that are the same company but with different capital structures to illustrate the points. And then, it concludes basically saying, for investment purposes, a company that has too much bonds is too speculative for investment. And, maybe it would be a good speculation, but it's too speculative to be considered an investment. And he also calls that many times in the chapter top-heavy capitalization. And then if you have a company that has too little bonds, like he's saying a lot of industrial companies in that time were experiencing, he says that's too conservative and for investment, actually. And then the middle ground is just right. You want your company to be able to smartly be able to afford the interest payments in good times and in bad, which gives the stockholders enough risk reward, and it and just makes everything run smoothly. And so if you have a company that has, quote unquote, too much bonded debt, what happens is it adds to the leverage of the stock. So, if a company is in bad times and they're barely able to cover their interest payments on their bonded debt because they have so much bonded debt compared to the capitalized stock, then the stock is not seeing any possibility of dividends coming in. And so, it leverages the stock price down because it's like, well, we're never going to get paid anything. And so, and he illustrates examples of companies that go between like $6 and $250 and then back down, depending on good times and bad times. And it's pretty easy to see that being able to happen when you have a company that has too much of their capitalization in bonds. And but this is a beautiful thing to be able to take advantage of as long as you can essentially time it right. One quote he says here that is in agreement with using, speculation, or, when it's priced low enough, he calls it an investment anyway. Throughout the whole book, it's all about figuring out the margin of safety, but that's not what this part's about. It's but he says, and I quote, "They can advance much further than they can decline." And so that's a good point to make. When you have a stock that doesn't foresee any payments coming in, it can be devalued, not to zero, to something above zero, unless they default on their bonded debt. And so as long as they're able to not go bankrupt and there's good prospect for the company to make decent profits in the future, the upside is much higher than the potential downside in that kind of a scenario. They can advance much further than they can decline. And then he mentions, like I said just now, the example of American Water Works in 1921, stock being priced at $6.50, up through 1929, where it was valued at $2,500. And then you got to go to the appendix to see that it went straight back down to $6 in 1938. And this is a example of a company having, a lot of bonded debt that was able to leverage the perceived value of the stock. And part of the reason for it getting so low is that its second preferred shares weren't even covered by its earnings. So, they were running a very thin line in the Depression, that followed 29, but also before. But that's that. And then we have another point made that that common is leveraged by bonds, including new issuance of bonds. And this is a really good point, I think, to get out of this, is that when you see a company offering more bonded debt, I see this all the time on like chat forums of that are talking about specific companies, and they're complaining, they're just borrowing more money. What do they need all this more money for? It's like, hey, hold on, stockholder. This is for your advantage. If they need to be raising more capital, you want them to be, doing a secondary offering. You want them to dilute the shares. Is that what you want while you're holding these shares? Like, no. When when you're owning stock of a company, you're utilizing the money that they're raising on the bond side to your advantage. It directly leverages up your ownership without diluting your ownership. And I think that's a very important thing to understand. Like good recent example is Sylbian Stillwater. Recently, their stock price dropped by 20% in news of raising $500 million of convertible bonds. And part of that is, it does entail a certain amount of dilution. How much, I don't know, but again, the fact that the capital's being raised with bonds and not directly like a secondary offering, it's going to help the stockholder in the long run. And that obviously that convertibility makes it more attractive so that they're able to raise more money on the, you're going to be able to get a decent premium on selling that. And so, I see on that, specifically on that company, people getting upset about this whole thing. And I'm reading this chapter and I'm thinking, well, this is probably actually a very well-run company. They've been around a long time. They've seen their ups and downs, seeing the price up and down. Their peaks and troughs of stock price certainly are a testament to being able to survive in bad times and being able to thrive in good times. It sounds like something quite interesting to me. Again, none of this is investment advice. Moving on. I wrote that I wanted to add here that Graham is okay with speculation if there's enough of a discount, margin of safety, and with enough margin of safety, along with diversification, like he says many times in the book, that's investment. It's a way to sort of use speculation like situations for investment. So. And then we say a point is made that higher earnings fluctuations means that lower bond debt is expected. Obviously, if your earnings are going to be fluctuating so wildly that, it's very possible or probable that you're not going to be able to cover your interest payments for a few years. Yeah, that's a pretty big problem for everybody. Nobody wants that. The stockholders, the bondholders, nobody. So you want it to be the right amount of bonded debt. And that's an important point. Again, he illustrates all of these things like through examples. I'm kind of pulling out the main points that I got from those examples. And then the next point I wanted to mention was he alludes to common stock, like I mentioned before in the video, using bondholder money to leverage profits, but also leverage losses of the company. However, as a stockholder, you have limited loss. Your stock can only go to zero, and it'll only go to zero in the case of default and bankruptcy. So then we have the last section where he talks about shoestring stocks. In other words, companies that, shoestrings. They sell shoestrings. Joke stocks. So, these are kinds of stocks that can even have more leverage than your regular stock when it comes to ups and downs in the market, or, the good times of the market, of the economy, or within that company or within that industry, whatever it is. He says, first of all, when these kinds of stocks are devalued, you might be better off just getting like a higher quality stock that's also devalued. But if you're going to go that route because you want even more potential leverage, which I think they give, it's to your benefit if you can find one that is largely funded with senior securities of the preferred share type, preferred stock. That's genius. You can't default on. You can default. On preferred shares, and then companies all have different rules. Like if they can't pay their preferred shares that are considered, like earlier in the book, he says, depending on the rules of the company and how they set up there's more details involved. However, officially there's no complete default risk for preferred shares, and so. If you're going into something super risky, buying very cheap shoestring stock, if they have a lot of bonded debt and they're not earning much money, that's a lot more worrisome than if most of the capital structure is funded through preferred shares. Huge advantage for the stockholder in between those two scenarios. And then the last point in this section and of this chapter is that the higher a price rises, especially of the shoestring stocks, the more risk is held. So, and I love hearing stories. I don't love it. Okay, so you have to appreciate hearing stories about people that bought some stock when it was $5 and it goes up to $300 and they think they're rich, and they don't just hold on to it. They buy more of it at that point, because why not? You're already rich, right? And then it goes back down to $5. And his point being here, remember when prices are going up, and I think this needs to apply to any securities that you own that go up by a very large margin. Understand, you are holding more risk now. The price went up. That money is not yours until you sell it. If you refuse to sell it, then that means that you are now holding a larger amount of capital value of assets that are at a much higher risk than you had before. When you bought it, when it was a much lower price, you were holding less risk, partly because the price, mostly, including the fact that, it's already so much devalued at that point. Your risk of loss is smaller than after it, multiplies itself by 200 or something, or 100 or whatever it is. And he points out an example of a stock that went from like $5 to $100. And, if you sold it at 100, you'd be kind of mad when you saw it go to 200, but, you're holding that much risk at that point. And it reminds me of hearing about how Powell himself was selling stocks, basically halfway up the big stock market rally after the pandemic. And, everybody including myself at that time, saying like, well, why did he sell early? He could have made so much more money. I think he's probably smarter than the rest of us in that regard. When you get good gains, take it and go. You don't need to squeeze every last drop out of the rising price of a security. And it reminds me of another point that I heard on a recent YouTube video of a famous investor talking about a famous book he read, saying the point that when you get into something, know how you're going to get out. Don't just buy it and pray. Know your exit strategy before you go in. And so that's everything I wanted to discuss for Chapter 40 of Security Analysis. Hope you enjoyed. Rob's Child.